Hello everyone, let's continue our class and before we go through more financial ratios, let's take a short review. Let me ask you three very simple questions. The first one is why? Why do we need to use financial ratios? Why? Well, the answer is very straightforward. For comparison, right? For comparison purposes. By calculating ratios, it can facilitate comparison, right? What kind of thing that we need to compare? Well, we do both historical comparison and peer comparison. And historical comparison is year-to-year comparison. So here we can know if company is doing better or worse compared to last year or previous years. And also we can use ratios to facilitate so-called peer comparison. So we can compare this company with other company, typically the competitors within the same industry. So to see if the company is doing better or worse than its competitors. Right? And those comparisons can help us to make better managerial decisions in a corporation. Now, second question is, how can we produce common size balance sheet and a common size income statement? Well, once you get a balance sheet and income statement, you need to calculate the ratios. And the common size balance sheet is a balance sheet that expresses all items in percentages of total assets. And a common size income statement expresses all items in percentages of sales. Now, third question is, what are 5 categories of financial ratios? Well, those 5 categories are, first, liquidity ratio. And the second, financial leverage ratios. Third one, asset management ratios. Fourth one, profitability ratios. And the fifth one is market valuation ratios. We just went through 3 of those categories, liquidity ratios, financial leverage ratios, and asset management ratios. And the calculating ratio is not our purpose. Our purpose is to utilize those ratios, right? To understand what those ratios mean and how can we improve the managerial decision for a corporation based on those comparisons. Now, let's switch to one of the most important ratios for a company, especially from a shareholder's perspective or from a management team's perspective. Right? Of course, the purpose of a firm is to maximize shareholders' wealth. Right? In order to maximize shareholders' wealth, company needed to deliver profits, cash flows. Right? So profitability is one of the most important issues for all managers and for shareholders as well. So here we look at the profitability measure of the company. I mean, here you see, okay, this company generated $363 million of net income in year 2014. Well, is that good or not? I mean, based on that single number, you cannot say anything. You cannot say anything. It could be really bad, it could be really good, but it really depends. Depends on those March benchmark. I mean, company made $363 million based on what? Based on a larger, large scale of assets, right? And based on large amount of sales, and based on large amount of shareholders' equity investment. So we needed to take a look at how efficient companies generating profits, right? And here we have three extremely important profitability measures. The first one is profit margin. The second one is ROA. Third one is ROE. Now, the first one, profit margin, equals NI. NI means net income. Net income divided by sales. It's called a profit margin. And here, total sales was $2.3 billion US. So that $363 million profit is based on $2.3 billion US dollars of sales. So here, the profit margin is 15.7%, which means for each dollar of sales, in this company, the company generated about 15.7 cents of profits. Is that good or not? Well, I would say, generally speaking, it's pretty good, but you still need to do comparison to see if it's good number or not. And the second one is return on assets. And here we divide net income by total assets. I mean, company utilize large amount of assets to generate the sales and profit, and you will see, I mean, here you want to examine how efficient company is generating profits based on total assets. And the number is 10.12%, which means for each dollar of assets managed by the company was able to generate a little over 10 cents of profit. The last one is return on equity, or ROE. It equals net income divided by total equity. It measures how much money the company is generating profit for its shareholders, right? And here 14.1% means for each dollar of total equity or shareholders investment in this company, the company was able to generate 14 cents of profit for its shareholders. Once again, you cannot say if those numbers are good or not unless you do comparison. Compare the numbers to previous years and compare those numbers to its competitors. In the last category is market valuation measure, and here we look at market price and to see how well the market is evaluating this company. And one important number that you need to pay attention to is earning per share, along with the market price. And the reason why stockholder pays certain price for a company is just because company generate earnings. So earnings per share is very important thing for any shareholders to look at. And in this case, it equals total net income $363 million divided by total number of shares outstanding, which is $33 million. So earning per share in this case is $11, which means for each share of the stock, the company is generating $11 of earnings. And here we introduce three market valuation measures. The first one is PE ratio. It equals stock price divided by EPS. And here stock price $88 and EPS $11. So PE ratio equals 8. What does that number mean? Well, P ratio measures how much money that shareholders are willing to pay at this moment for each dollar of earnings that will occur within the firm every year. All right. So the shareholder right now is paying $8 for each dollar earning that can be generated by the company for every year in the future. And the PS ratio equals stock price divided by stock price divided by sales per share. So here you see 2311 divided by 32. That what is that? That is sales per share. So we do calculation on per share basis. So essentially, it's price divided by total sales per share, and is equals 1.26. Is that good or not? Well, you have to do comparison. Market to book ratio, and market valuation for each share of stock is $88. Right? But what is the book value for equity? Book value of equity equals total equity divided by number of shares outstanding, which is $78.52. So the static or the book value that you can see in the balance sheet for each share of stock is $78.52, and the current valuation for each share of stock is $88. So market to book ratio is 1.12 times. So market evaluate company's equity slightly higher than its book value, right? 12% higher than its book value. That is another market value measure, market to book ratio. And here's more market value measures. First one is enterprise value, and here we look at total market value of the stock and and the total value of all liabilities minus cash. So that is so-called enterprise value. So enterprise value combines both equity and the debt. And the reason why we exclude cash is we are calculating the net debt taken by the company, and in this case, the enterprise value for the company is about 3.8 billion US dollars. So this number tells total market valuation for equity and the debt of the company. EBITDA ratio equals enterprise value divided by EBITDA, right? Enterprise value divided by EBITDA, and this is a pretty good financial ratio for stockholder to evaluate its stock price, to see how high or how low the stock price is evaluated. And here's a summary for ProofRock company's financial ratios. Once again, you see 5 different categories, and within each category we have alternative ratios to measure every aspect of operations of the company, from liquidity to financial leverage to asset management, profitability, as well as market value. Once again, when you look at those ratios, I mean, it take you a while to come up with those ratios by doing calculations based on all those formulas. But once you get this table, what I can say here is it's still useless. It's still you just cannot tell if a number is good or not, right? And to make those numbers useful, first ask yourself, what a specific number mean first, right? So what does, for example, what does current ratio 1.31 mean? Well, you should understand, okay, 1.31 means for each dollar of current liability, there is a pretty sufficient backup from the perspective of current assets. So for each dollar of current liability, there $1.31 of current assets as backup. So you need to interpret the meanings of those ratios, right? And the second, you need to do comparison. Right? You probably need to compare those numbers with previous year's numbers, and compare those numbers with its competitors' numbers to see if it's good or worse. And table 3.6 showed you the comparison example for Lowe's and Home Depot. As we know, Lowe's and Home Depot are close competitor in the same industry, although the size is different for those two companies, but we can do comparison. Right? And here you see sales are different, net income is different, current assets is different, but we can do ratios. So those ratios can help us to compare those two companies. For example, current ratio 1.28 for Lowe's and 1.55 for Home Depot. So in this case, we would say Home Depot has better liquidity than Lowe's, right? And debt to equity ratio is higher for Home Depot, which means Home Depot utilize more debt than Lowe's. Profit margin is higher for Home Depot, 5.5%, versus 3.66% for Lowe's, which means Home Depot is doing more profitable business than Lowe's. And ROE, in terms of ROE, you see huge difference. 11% for Lowe's and 21.7% for Home Depot. So Home Depot does much better job than Lowe's in generating profits for its shareholders. And for ROA, you see the difference is significant, right? 5.48% for Lowe's and nearly 10% for Home Depot. So that explains a little bit why the market gives higher valuation to Home Depot than Lowe's, reflecting market to book ratio, although price earnings ratio are similar to each other. So this table showed you one example on how to utilize ratios to facilitate comparison. especially the peer comparison. Now, let me introduce a very, very useful tool in financial ratio analysis. It's called DuPont identity or DuPont equation. And this equation was discovered by a finance team working for DuPont company many years ago. So even today we call that formula as DuPont equation. So this DuPont equation is the outcome of teamwork. And this DuPont identity deals with just one important ratio, that is ROE. That is ROE. What is ROE? Return on equity. Return on equity is one of the most important profitability measures. It measures how efficient the company is generating profit for its shareholder. Why is this important? Well, the goal of a firm is to maximize shareholders' wealth. Right? In order to maximize shareholders' wealth, a company needs to deliver cash flows and profit every year, not just in the past, but also in the future. And the most common way for us to understand how shareholders' wealth serve is to look at its profit or net income. So here, ROE is very important. And ROE can be high, can be low, but this DuPont identity or DuPont equation helped us to understand three critical drivers of profitability. Three critical drivers of profitability. The first one is PM. PM means profit margin. Profit margin. Right? And the second one is total assets turnover, and the third one is equity multiplier. Let me interpret those things a little bit. I mean, the PM here, profit margin, is the source of profitability. I mean, you have to generate a profit from each dollar of sales, no matter what. If you cannot generate any profit from sales, then your business will be a total failure. And here, net income divided by sales will give you profit margin. That is source of profitability. As we know, many companies have really low profit margin, especially in competitive environments such as automobile industry, such as retail industry. Typically, their profit margin was as low as 2-3%. But as shareholder, you probably would expect much higher return than 2-3%. So here is the most important strategies that each and every company utilize in order to improve its profitability for shareholders, right? For shareholders, to make company attractive to any shareholders. And the key here is use leverage. Use leverage. And a typical company will use two different types of leverages. The first one is operating leverage. The second one is financial leverage. Right? And once those two leverages are used, the return for shareholder can be improved by twice. Once by utilizing leverage for operation, and also the usage of financial leverage. So those leverages are like amplifier, the amplifier of profitabilities within the firm. And as you see, the source of profitability is profit margin, and that profit margin can be amplified twice. One through its operating leverage, and the second time through its financial leverage. And here, total assets turnover, TAT, is total assets turnover, which equals sales divided by total assets, measures operating leverage, right? And second leverage is financial leverage, and here we use equity multiplier to measure it, which equals total assets divided by total equity. So this return on equity start with the profit margin, and this profit margin can be amplified twice. Once by using operating leverage, which can be measured by total asset turnover, and twice by the financial leverage, which can be measured by equity multiplier. And you can do the math here. ROE equals net income divided by sales times sales divided by total assets times total assets divided by total equity. And then you see sales cancel off, total assets cancel off. What's left here is net income divided by total equity. That is the definition for ROE. So mathematical manipulation here seems pointless. However, this mathematical manipulation reveals three critical drivers of ROE, right? Profit margin, total assets turnover, right, which is the proxy for operating leverage, and the financial leverage, right? Financial leverage expressed in equity multiplying. And here's more information for ROE. And here's a shortcut for you to calculate equity multiplier. If you know debt to equity ratio, then equity multiplier equals 1 plus debt to equity ratio. Now here's an example in utilizing DuPont equation for Proof Rock company. And here you see four critical ratios. ROE, which is the profitability ratio, that equals net income divided by total equity. It equals profit margin times total asset turnover times financial leverage. And here, profit margin pretty high for this company, 15.7%, but its operating leverage is low, 0.64, and the financial leverage is 1.39, and that combination will result in 14% of return on equity. So essentially speaking, I mean, in evaluating the drivers of profitability for this company, we can say that, okay, the major source of profitability is profit margin. And the company has pretty low operating leverage, and that low operating leverage was offset partly by a little higher financial leverage, because somehow company utilized the debt, not much, but some debt, and those two leverage cancel off each other, generating basically zero amplifying effect, and that's why ROE is 14%, slightly lower than its profit margin. But for many other companies, you would see, for most other companies, you will see pretty low number for profit margin, but significantly higher number for total assets turnover and financial leverage. Now, let's look at the momentum of the stock price, right? The momentum of the stock price, or the future of the company. When investors buy a stock, they expect the stock price to increase, right? And for stock price to increase in the future, the company has to have one thing, right? Has to have one thing, and that is the most important thing that can drive stock price to go higher. That is growth. Right? Company need to have growth in sales in order to get higher profit, and higher profit will drive up the stock price. So the growth is the most important concern for many investors. So let's take a look at this growth, or G, to see how company can generate growth. Right? And here we're gonna introduce two different ideas. One is internal growth, the other one is sustainable growth. Let's start with dividend payout. When a company made profit, they pay dividend, but most company won't pay 100% of its profit as dividend. Somehow they keep some money within the company for future investments. So this dividend payout ratio measures how much money has been paid out as dividend from net income. It equals cash dividend divided by net income. And what's left with the company is the money that the company can utilize for future reinvestment. And this retention ratio, B, Retention ratio measures how much money has been retained within the company for future investment. For instance, net income equals addition to retained earning divided by net income. That is net income minus dividends divided by net income. Right? So that measures how much money was kept within the company for future investment purposes. It's called retention ratio. And retention ratio is B, and the payout ratio, of course, equals 1 minus B. Both are in ratios. And here's an example to see how we can calculate dividend payout ratio. And here, cash dividend for company is 121, and total net income 363. So dividend payout ratio is 33.3%, which means for each dollar of profit the company made, $1 was paid to shareholder as dividend, right? And that means $2 was kept within the company. Right? $2 was retained within the company for future reinvestment. Right, so retention ratio here is 66.7%, or two-thirds. Now let's take a look at how company can grow. I mean, company can only grow based on reinvestment. If company stop invest, there will be no growth. And in order to generate growth, company has to invest. And here, internal growth rate showed how much the company can grow assets using retained earnings as the only source of finance. Let's say company kept some profits and retained earnings, and assume that the company can only use that proportion of money for future investment. Then what would be the future growth rate? Right? And the formula here shows you that, okay, internal growth rate equals ROA times retention ratio. This B is retention ratio, right? Divided by 1 minus ROA times B, right? This ROA is return on assets, and the internal growth rate will be 7.23%, which means if company rely on retained earnings for future investment, then the growth rate should be 7.23%. Right? The reason why we put internal here is because the company only uses internal source of money, retained earnings, for its investments. Now, let's assume that a company can borrow money in addition to retained earnings for future investment. Then we can calculate so-called sustainable growth rates. Right, based on not only retained earnings, but also the money that a company can borrow to a point that a constant debt ratio is maintained within a company. And you can find that debt ratio from the balance sheet. Right? So in this case, sustainable growth rate equals ROE times retention ratio divided by 1 minus ROE times retention ratio. And that will give you 10.29% of sustainable growth rate. Sustainable growth rate is higher than internal growth rate because we have more investments. Right? We have more investment that can be made through debt financing. Which was supposed to call a sustainable growth within the firm. And from the equation, you will see very clearly there are several determinants of companies' future growth. First of all is profit margin. Second one, total assets turnover. Third one, financial leverage. I mean, all three things are three things measured in. Three things that you deal with in DuPont equation, and there are three drivers of ROE. And the fourth factor is dividend policy. If company pays more money in dividend, then there will be less momentum that can be generated by future investment based on retained earnings. Now, let's take a look at one example to see how we can use DuPont equation to facilitate our financial analysis. And here we have two companies, one Yahoo, one Google, and also we have 3 years numbers for those 4 very critical financial ratios within the same formula called the DuPont equation. ROE equals profit margin times total assets turnover and equity multiplier. Let me emphasize this for one more time. The profitability is the source of profitability, and the total assets turnover measures operating leverage, and equity multiplier measures financial leverage. Now, let's take a look at Yahoo from year 2009 to year 2011. Let's compare year 2011 with year 2009. So, you see different numbers, but you cannot tell if a number is good or not unless you do comparison. So let's do the historical comparison first. Compare Yahoo from year 2009 to year 2011. In year 2009, ROE was 4.8, right? But it has been improved tremendously in year 2010 to 9.8%, but declined to 8.4% in year 2011. So what was going on? What was going on? In order to understand what was going on, you needed to decompose ROE into three drivers, right? And here you see in year 2009, profit margin was low at 9.3%. Total assets turnover 0.433 and equity multiplier 1.2. So what happened between year 2009 and year 2010 is profit margin has been more than doubled to 19.5%, while operating leverage and financial leverage are about the same. So the major driver for high ROE in year 2010 compared to year 2009 was that the profit margin has been increased tremendously, right? Tremendously. Now let's compare year 2010 to year 2011. ROE has been declined by 1.4%. So what was going on? Here you see what was going on. First of all, profit margin has been increased. Well, that's kind of surprising, because if profit margin is increasing, you would expect ROE to increase, right? But actually it declines. So what was going on? Well, you need to take a look at two amplifiers. One is total assets turnover, the other one is equity multiplier. And here total assets turnover has declined, right? Pretty significantly from 0.424 to 0.337. Although equity multipliers stay pretty stable, but decline slightly from 1.19 to 1.18. But here you would say, hey, the major contributor for low ROE in year 2011 for Yahoo is due to its operating leverage. Because the total assets turnover was significantly lower. Although profit margin has been improved, but the major dragger here is operating leverage or total assets turnover. It looks that Yahoo needs to find a way to improve its daily operations so that asset management can be improved, because this total assets turnover measures total asset management efficiency. They need to improve the efficiency of total asset management. Right. Now, let's look at peer comparison. Let's compare Yahoo with Google in year 2011. Well, Yahoo has decent ROE, 8.4%, but Google has 16.7% ROE. It's nearly double. So why Google has such high ROE relative to Yahoo? They are competitors in the market, and in order to understand the difference, we need to do DuPont analysis. Let's take a look at what's the difference in profit margin, total asset turnover, and equity multiplier. So here, when you look at the profit margin, you found that Google has better profit margin. For each dollar of sales, Google is generating more profit. So the source of profit is stronger in Google. That explains why ROE is higher. But it only explains a little bit, because there are two other drivers driving up its ROE. One is through operating leverage, and total asset turnover of Google is 0.522. right? And that number was 0.337 for Yahoo. And in this case, it showed that Google has much better total asset management. Right? So the implication here is for Yahoo, if Yahoo need to catch up with Google in the future, they need to figure out a way in its daily asset management. Right? They need to figure out a way to manage better their cash, their inventories, their total assets, so on and so forth. There's a big gap to catch up relative to Google. And for equity multiplier, Google has slightly higher debt level, and reflecting equity multiplier, that's a 1.25. So Google has higher financial leverage, and here you see all three drivers helped Google to deliver a much better ROE, 16.7% relative to 8.47% for Yahoo. So this table showed you once again how to do first historical comparison, and second peer comparison based on 4 very important ratios within the DuPont equation. Now let's look at some major issues associated with financial statements analysis. First one is, who are users of those financial statement ratios, financial statement and financial ratios? And there are 2 major areas. One is internal uses, the other one is external uses. Internally, manager can utilize the financial ratios to do 2 things. First one is performance evaluation. Right? And so that compensation can be properly determined based on performance of the company. And also we can do comparison between different business divisions to see which business unit did better than the others. And second important usage is planning for futures. Right? As you see through the financial ratio analysis, through those comparisons, company can actually figure out a way to identify the strengths and the weakness of their business operation, and therefore they can figure out what they needed to do in the future in order to improve profitability based on different asset management in different areas, such as inventory turnover, account receivable, fixed assets turnover, so on and so forth. Right. So it has managerial decision usage for financial ratio analysis. And for external uses, financial statements, information for financial statements and financial ratios are intensively used by all stakeholders within the firm. First one is creditors. They are bankers. They are money that lend, their businesses or individual lend money to a corporation. Suppliers look at the situation of the company to determine how many credit they can extend to a certain company and how much goods they can deliver to the company. Of course, customers are looking at the financial statements, analyzing ratios to see how well the company is running. And the last one, of course, the most important one here is stockholders evaluating financial ratios intensively, trying to understand how well the company is running its business and how fair the stock price is evaluated by the stock market. And as I said, comparison is key, and those ratios can be used to do both historical comparison and peer comparison, and sometimes we call those comparison as time trend analysis and a peer group analysis. In the future, if you decide to develop your career in finance, what I can say here is very likely that you need to deal with the financial statements and the financial ratios for the rest of your life. And there are many advantages and benefits that you can get from financial ratio analysis, but keep in mind there are potential limitations for financial analysis. Right? And here are major problems that all financial analysts are facing in today's business world. They need to look at global competition. They need to understand different accounting procedures, different fiscal year ends, differences in capital structures, and they need to understand seasonal variation versus one-time investments for those. So there are a lot of problems that a financial analyst actually need to deal with, right? In addition to those very basic financial ratio calculation and financial ratio analysis. So financial analysis is a very basic skill that any finance people need to master. Right? And we rely on financial statements. Therefore, I would say for any finance people, you need to be a really good accounting guy. And accounting is important. Accounting helps us to understand what's going on in the firm, and it can help us to facilitate our financial analysis through accounting statement reading and financial ratio calculation and comparison and so on and so forth. So if you decide to pursue career in finance, you need to be really good at accounting. You need to develop a strong skill set called financial analysis. So you can take future jobs such as financial analyst in a corporation, right? A credit analyst in a commercial bank, a financial analyst for investment bank, right? Or financial analyst for private equity companies and all kinds of financial firms. And financial analysis is a very basic skill that you need to master if you decide to pursue a career in finance. That's how important chapter 2 and chapter 3 are in this course and for your future finance study. And here's a quick quiz questions. How do you standardize balance sheet and income statement? We already fixed this one after the break. What are major categories of ratios, and how do you compute specific ratio within each category? So here I want you to print that ratio formula slide, and make sure it's handy when you need to deal with the homework questions. And third one is, what are major determinant of firms' growth potentials? And here you need to take a look at how internal growth and sustainable growth can be generated. Can it be generated based on retained earnings and so on and so forth? And the last one, what are some of the problems with financial statement analysis? So before you go to next lecture, I want you to briefly review those questions. And once again, I want you to practice the homework questions. If you have any problems, difficulties, please email me or put your questions in the discussion forum of D2L. This is Kevin Zhao. It's my pleasure going through those financial analysis skills with you guys, and I will see you in next lecture.